We're talking about food inflation with our Taking Stock think tank. Frederick Kaufman is a professor of journalism at the CUNY College of Staten Island. Alexia Howard covers food stocks as an analyst for Sanford Bernstein. Dennis DeLaughter owns Progressive Farm Marketing and manages over 6,000 acres of rice and grain farmland in Texas. And we have Alex Wittenberg, a partner at Oliver Wyman, just co-published a study that shows that wheat crisis could cost the U.S. food industry more than $2 billion. Dennis DeLaughter, are farmers able to actually use the futures markets in the way that they were intended to hedge their risks having to do with big changes in prices?
Well, that's a really good question, and my answer is partially. If you look at the current level of the futures market and then the price that the farmer can get for it, there's a dramatic difference. For instance, I've sold all of my wheat for next year, the wheat I'm getting ready to plant, and I sold it at $7 in the cash market, while the futures market was almost $8. That is a huge basis or a difference between the two. So what's happened right now is we have a group that would like to use the futures market but are concerned that there's not going to be the convergence between the futures market and the cash market.
Frederick, isn't that the big issue, is that at a certain point, these contracts that people use to speculate and to hedge on various commodities, the price has to converge to the cash price. Either the cash price has to meet the futures price or the futures price meets the cash price because the contract expires at a certain point.
Let me tell you, this is the essence of the problem and a complete and total outrage, because the fact that the futures and the spot failed to meet made it impossible for people to manage their risks and to price those commodities. And this was the basis of the Senate investigation. The Senate Committee on Homeland Security had to investigate the commodity markets simply because they were interfering in interstate commerce. We have all these forces at work in the commodity markets, and they are based in the theory and practice of the ETFs, of the electronically traded funds, and the long-only index funds. And something is very rotten in these markets right now. Something is very rotten.
Alexia Howard, the companies that you cover, what has been their typical response to the volatility in food prices and in the underlying commodities? Has it been just to access the futures markets even more, or did they decide to maybe source their supplies through other different types of supply chains?
In general, I think they've been extending the hedges, particularly in the grain markets. We've seen a lot of that. We have seen a number of companies getting a little bit more sophisticated when they're doing forward contracting with their individual suppliers, so we've certainly seen that as well, and trying to get just a little bit more savvy about how they link what they're seeing on the input costs with the way that they're passing through to their customers. So we've really seen them trying to pull all these levers. 3 or 4 years ago, when they hadn't had to deal with this for a decade or so, they really weren't expecting the kind of bubble that we saw in 2007, and it took them by surprise, but they are working now to get more sophisticated.
Alex Wittenberg, what about the supply chain for food and commodity basics? Is that something that's got to change? Maybe it moves away from using the futures market and it just ends up being a one-to-one relationship.
Right. I think you're seeing a couple of things happen. And, you know, I mean, in terms of looking at how you deal with your commodity exposure, I think you see a lot of firms starting to move upstream in terms of securing supply, working directly with producers in both, not just in securing the actual commodity itself, but in the development of the commodity, technology to develop the commodity, investment in increased storage so that they have a little bit more control and stability in their own supply chain. I think also what we're starting to see is organizations at all levels, even kind of what I would call mid-cap food producers, looking across their entire portfolio at, looking at how different commodities respond to external events, but also adding things like energy and currency into that same basket and looking at the overall portfolio.
Yeah. Dennis DeLaughter, you were talking about farmers and the amount of sort of sales that they are dealing with in terms of the futures market and saying, well, they partially use that now. What's the alternative? Because with government programs and the futures markets, weren't they supposed to, in tandem, maintain some kind of equilibrium when it comes to prices?
Well, yeah, that's true. And to be perfectly honest, they are using the futures market. It's just that they cannot rely on the price that the futures market is quoted at to be the price that they get. I mean, right now today we're looking at 60 to 70 cents under. When you look at the involvement of the funds and the different speculators in the market, when you look at their percentage right now, for instance, the funds in wheat, they really own only about 25% of the wheat that we produce in the United States. So it's not like they've got the market cornered. It's like that we have a situation where the producer needs to be able to sell wheat at the price it is on the board and know that's approximately what they're going to get. And that's the big issue that we have on the farm. Now, we know, by the way, that the Chicago Mercantile Exchange, they're dealing with that. They've tried to put in a new system, a variable rate system, to see if they can't help that convergence. But we don't see it working down here on the farm. What we look for from the government at this particular point in time is for them to look at that convergence, see if they can't do something with it. And then, of course, at the same point in time, we have to realize that there are outside factors and forces that are really driving this market higher. It deserves to be higher, but the farmers deserve the ability to sell it where the price is in the futures market.
Frederick Kaufman, if the government does not intervene and somehow check the use of these derivative contracts or futures contracts, what happens to the price of food?
Well, these contracts are, for the most part, regulated and traded on markets. So that's really not even the problem. And one of the things we should also think about is from the investor side. These markets were really never created for buy and hold funds. Investors want to buy and hold. They want to take large stakes. They want to hold those stakes. And guess what? Those investors have been losing money.